Hello and welcome to Moneycontrol. I'm Kayezad, Adajania. It's been 9 months since we've been talking about debt funds, and we still continue to talk about debt funds today because the credit rout in the industry continues. Today I have with me Marzban Irani, who is the CIO of fixed income of LIC Mutual Fund, who's here to tell us about how debt fund managers manage their funds in the wake of such crisis. Hi Marzban.
Hi Kayezad.
Welcome to the show.
Thank you.
Let me just first start by asking you, there's lots been happening on the debt funds. You're a debt fund manager, obviously you know what's happening on the ground. So tell us, is there more pain left in the system? I mean, just today we are, this whole week, we've been hearing about Café Coffee Day and how some fund houses have, brought down the value of their exposure to Café Coffee Day scripts and all. But of course, this is just one example. We've had many examples in the past. So is the worst yet to come, or have you seen the worst? What's your reading of the entire scenario?
Okay, so worst can come anytime. Actually, it's not any particular time that the worst can come. But I don't think it's over yet, the way something or the other is coming up. And it's not about one company having a problem. You know, it's about the percolating effect after something happens. So that is the concern. But here, having said that, I would just say that when the investors make their investments, what are the things they should, look into, because this can happen anytime. It's not that we are going through a credit drought period, and hence a lot of investors are asking us whether, now can we start investing? Is everything over? Okay. It's not like that. At any point in time, they should be alert as far as the fixed income is concerned. They should give more focus to the portfolio quality instead of the running yield, portfolio yield. So I think I would say that, people chasing returns leads to this. The common thing, the formula that we know is high risk, high returns. So when people are chasing high returns, obviously they are facing higher risk.
But when you as a fund manager are investing and managing your debt funds in these volatile times, do you have to take any additional precaution, any additional care to see that, you don't end up lending to, borrowers who are either suspect or either weak balance sheets?
Yeah, so any investment we have, our investment philosophy is like SLR process, safety first, then liquidity and returns. Okay. Because as we know, debt markets in India are not very liquid. Okay. So we first focus on safety of at the time of buying. We have a list of investments where we can invest only in those companies. Okay. We have a credit process by which it is approved by the credit committee. Okay. So our fund managers invest only in those companies. Okay. Then we look at the liquidity. As I said, the liquidity in debt market is not very deep, as far as this country is concerned. So we look at the liquidity, and at the end of the day, we are pass-through vehicles. Okay. So when the investor comes with a redemption, we are supposed to sell that at a good price and meet the redemption.
Correct. So you need to have the money to meet
to meet the redemptions. So liquidity is something, and obviously returns is surely that we look at, but that is the third criteria which we.
That's not the first criteria.
Yeah.
But so far, Marzban, I take your point that your portfolios haven't really been embroiled in any of the credit crisis that's been happening elsewhere in the funds. But looking back, of course, it's all very nice to say that you follow the SLR method: safety, liquidity, and returns in that order. But honestly speaking, Marzi, have you been a little lucky in terms of having avoided the entire credit crisis, or is there more to it? Okay,
so I would say, in most of the portfolios that I manage, there is not, I think, we go through the base process, before investing. So we take a lot of, pains before investing. After investing, you can't do anything. Yeah. So I would not say I have been a bit lucky, but as we were entering into this credit route kind of a situation, there are a lot of papers where we were investing, which we stopped investing. Okay. So say for example, in our liquid fund where we invest for 2 months, 1 month, so, there we were buying into a lot of papers, which we stopped investing once we thought that there can be any liquidity issue or any, crisis kind of situation. Okay. So, once this type of scenario started, we have been a little cautious, and that has really helped.
Okay. Okay. And so, tell me something as to how fund managers usually, like what happens behind the scenes, when normally one of these credit incidents come up. It's an open-ended fund, and constantly redemptions keep coming in, especially in these crisis times. People would want to take their money and go out. But at the same time, if fund managers, I'm not saying about you specifically, but any debt fund manager who's been stuck with these papers, you obviously can't sell these papers overnight. You would want to, but you cannot because there are no buyers over there. So there is some amount of liquidity. illiquidity in that papers. What do you do? What do fund managers do in that case?
So, as you mentioned, the ideal thing would be to sell the paper at
Yeah.
whatever price you get, because as we mentioned, there's no liquidity in the market. But the second option would be side pocketing, which is happening just now in the industry.
Yes.
But again, in case of side pocketing, you have to take the board approval, you have to give the exit option to the investors.
Yeah.
And suppose for one paper you do, say, side pocketing, what if you get another NPA in your portfolio or a third NPA? How many side pockets are you going to create?
Okay.
The third situation is, in certain AMCs, if there is a credit issue, the AMC has written off they bring the value to zero of that particular paper. And then whenever you get the money, whatever the NAV will jump to that extent. Now, to protect the existing investors, once you write off that paper, you have to put some load. So some AMCs have done that. They have put some exit load and all that.
Or you stop fresh investments.
Correct. It's a way of stopping fresh investment by putting the exit load. Okay. So no new investor will come and eat away into the returns of existing investors.
Marzi, there's one more method that some fund houses had adopted in the way past. In 2008 crisis, we saw one fund house particularly did the same thing just in the recent past. That's where the sponsor of the AMC comes in, and the sponsor takes over the bad paper to tide over the liquidity crisis, gives the money to the fund house, and the fund house can then pay the money back to the investor. Now, Marzban, you are a manager of LIC Mutual Fund, and you have one of the country's largest institutions as your sponsor. Does that give you any comfort?
Yeah, so coming to this type of question, if this type of situation occurs, I believe that, this is one of the case, which has happened. And the amount was, X amount, which the AMC could take the hit. Okay. So probably it was done. Nowadays, in the last 10 years, that you mentioned from 2008 till now, the size of the AMCs are increasing, the fund sizes are increasing. Okay. People are running 20,000, 30,000 crores worth of funds, each scheme. Now, 10% of that is around 2,000, 3,000 crores. Just imagine one paper goes for a toss. You think a AMC will take a 2,000 crore hit every time this happens? It's not a practical solution. People have to understand that there are some risks involved. Okay. So that's why I was emphasizing more on portfolio. Okay. That is what I feel. What people can take the comfort as far as the parentage is concerned. Yes, parentage is very important. So processes and all these will be, a robust process would be imbibed into their subsidiaries. Okay. So that is the comfort one can derive from a good
So basically
parentage.
good parentage is what you're saying makes a difference in this particular case.
Because it will be worried about its reputation, so they will never adopt any wrong practices.
Okay. Marzban, let's turn our attention to the forthcoming credit policy. People want to know whether there's going to be a rate cut or whether there's going to be, sustenance of the same rates. What do you think? I mean, the finance minister has said that rate cut is required for the economy. What do you see?
I think more than finance ministry, if you look at the MPC last minutes, it's very clear that they are tilted more towards growth than the inflation. Our headline inflation has been under control, and there is comfort from the RBI side. Okay. I think it is the growth that is suffering, and not only on the domestic front, globally also there are concerns as far as growth is concerned. Okay. So, I think there should be a probable cut as far as the policy is concerned. The market has also discounted that in the current prices. Okay. In fact, this cut doesn't turn up, then there will be some correction in the yields. Okay. So I don't think that is going to happen. Currently, there is some concern on the growth, so we are expecting a cut over there.
So you're expecting a rate cut, Marzban, on the 7th of August credit policy. Yes. Okay, but one last question before I let you go, Marzban. Again, coming back to liquid funds, recently there was SEBI intervened and gave a whole host of new guidelines for liquid funds, and it said that all liquid funds will have to have a compulsory graded exit load structure for the first 7 days. So do you think that this is going to, have more volatility? That's one, by the way, that's one measure. Second measure is also all the securities within a liquid fund have to be marked to market. So both these measures, Marzban, how do you think it's going to affect the liquid funds?
Yeah. So in the last 2 decades that I've been in this industry, whatever measures SEBI has taken, they are really excellent. I should praise SEBI for that. Making it mark to market, basically what is the difference between M0 and M2M? Suppose you had a 60-day paper earlier in your portfolio and it was valued at 8%. Something happens in the market and the yield goes to say 9%. Then your paper continues to remain at 8. So it was not a correct valuation.
Devoid of reality.
Yeah. So now they have brought it, all your money market papers are mark to market. So that is a realistic valuation as
More
the NAV
volatility?
which comes out.
More volatility?
So that will lead to volatility, but it is the right, pricing that should come out as a NAV. Okay. And coming to the 7-day load and all that, SEBI is of the opinion that those investors who want to come for one day, there is an overnight fund for those investors. So that's why liquid should be a 7-day kind of investment. So that is why they are trying to introduce that going ahead. So I think that is also a good measure from the regulator's point of view.
Thank you, Marzban, for those insights. That's all from us, folks. For more news, views, and updates, log on to moneycontrol.com.